Hey everyone, and welcome to today's Explainer. So, have you ever carefully analyzed a stock chart, executed what felt like an absolutely perfect trade, and then watched in sheer disbelief as the market immediately reversed and took your money? I mean, you literally sit there thinking, is the market actually out to get me? Well, today, our source material pulls back the curtain on exactly why that happens. Our ultimate goal in this explainer is to expose how large institutional players, the smart money, manipulate the market. Get ready because we're about to change the way you look at trading forever.
Okay, let's dive into this. It is so incredibly frustrating, isn't it? You read the books, you learn the patterns, you do everything right. You patiently wait for the breakout, you enter the trade, and bam, you hit your stop loss. It feels like terrible luck, but the data actually shows it's by design. What you are experiencing right there is the smart money trap.
You know those classic double tops, the head and shoulders, the wedges? These patterns are standard and they're totally open source. You can literally find them anywhere on the internet. And, well, that is exactly the problem. Because these patterns are so widely available, the massive institutional players, we're talking banks and hedge funds moving billions of dollars, they see exactly what you see. They know exactly how you have been trained to trade these formations.
So, to understand how these patterns are manipulated against you, we first kind of have to ground ourselves in basic market structure. Market structure is really just the simplest form of how price moves. It's the foundation of all those charts, built on support and resistance levels, and the natural ebb and flow of swing highs and swing lows. It dictates how price and volume behave in any given environment.
There are really only three baseline directions the market can take. You've got your bull trend, the uptrend, marked by higher highs and higher lows. You've got your bear trend, the downtrend, making lower highs and lower lows. And finally, the sideways trend, where the market is basically range-bound. These are the absolute foundational rules of the game that every single trader is playing by.
Now, the sources outline an ultimate predator-prey dynamic in the financial markets. Think of it like this. That massive school of small fish, that represents the retail traders. That's you and me. And that huge, hungry shark looming around them, those are the big traders, the institutional players. To survive out there, you've got to stop acting like a small fish and start acting like a smart trader, one of those smaller sharks who patiently follows the moves of the massive shark.
Let's put this into perspective and directly contrast these two players just so you really grasp the massive disadvantage retail faces. Retail traders make relatively small trades. We're focused on short-term price movements, right? Just trying to scrape together quick profits based on simple patterns. But the big players, they deal in massive volume. Because they're moving so much capital, they can't just hit buy or sell whenever they want. If they did, they drastically alter the asset's price. So instead, they use highly sophisticated, long-term strategies to set traps and actively generate the liquidity they need. And this brings us to a total matrix reveal moment from our sources. It is not bad luck when the market reverses right after you enter. No way. Big players actively hunt the exact levels where retail traders place their stop losses. Why? Because to fill a massive buy order, a big player literally needs a massive amount of people willing to sell. By triggering your stop loss, they force you to sell your position, handing them the exact liquidity they need to enter the market at a premium price.
Let's walk through how this liquidity hunting builds into a very real trap. Imagine a textbook uptrend channel. To a new retail trader, this looks absolutely beautiful. The market is aggressively moving up, bouncing perfectly within these parallel lines. The retail mindset immediately goes, wow, this is strong, it's going to keep going, I need to buy right now. They are terrified of missing out on the rally.
But let's look at what's really happening near the peak. You have to hack the seller's mindset here. The traders who bought early, they're already sitting on massive profits, and they are gearing up to sell to lock those profits in. At the exact same time, big players are activating huge sell orders because they see the resistance. They deliberately push the price up just a tiny bit to trigger a fake breakout, inducing late, unsuspecting retail buyers to jump in. As soon as retail buys the hype, the big players dump their massive positions and the market crashes downward.
Now, what's truly wild is how they use this exact same psychological warfare in a downtrend. The market hits a support line, and then a solid red candle breaks right through it. If you're a retail trader, you see this breakdown and think, perfect, the support is broken, it's going lower, I need to short sell immediately.
And bam! Right there is the exact moment the trap snaps shut. Retail traders aggressively sell the breakdown, flying completely blind, without waiting for any kind of confirmation candle. They confidently place their stop loss just above the line. But what they've actually done is provide fresh, perfectly placed liquidity for the big players who secretly want to
buy.
The aftermath is just devastating. The sources call it the cruel reversal. The second all those retail sellers enter the market, the big players buy up all their orders. The price instantly reverses upward. And what happens next? It shoots past that support line, hunting down all those retail stop losses. Those triggered stops act as even more buying pressure, fueling the reversal even faster. Once the retail traders are entirely wiped out, the market is free to rally in the originally predicted direction, leaving the small fish totally empty-handed.
Trading with smart money, the survival guide.
So, how do we actually stop bleeding capital and start swimming alongside the sharks? Well, these are your new rules of engagement pulled straight from our source material. First, always identify the true underlying trend. Second, and this is a real game changer, never ever trade a blind breakout or breakdown again. The big players are literally waiting for you there. Instead, Rule 3, demand patience and always wait for a confirmation candle. Finally, practice hacking the seller's mindset. Ask yourself, if I were a big institution with immense profit here, where would I want to induce retail to trap them?
To survive, you must execute every single trade with strict discipline. Think of this as the life cycle of a smart trade. You don't just jump in. You set highly precise entry points based on confirmation. Before you even click buy, you define a stop loss based on a risk level you are 100% comfortable losing. You set a realistic take-profit target based on market structure, not greed. And, most importantly, you actively manage that position, eventually exiting with rigid discipline rather than letting emotion take the wheel.
Actually, I really want to highlight this specific vital survival tactic. As you move into profit, you must actively manage your trade by trailing your stop loss upwards. This is exactly how you protect yourself from sudden institutional manipulation. Because look, even if the big players suddenly decide to trigger an aggressive reversal to hunt liquidity, your trailing stop loss ensures that you're kicked out of the trade with your profits safely secured. You still get to take money home.
Well, we've reached the end of our explainer. The curtain has finally been pulled back. You now know exactly how open source patterns are used against you to generate liquidity for massive institutional orders. You know the dark mechanics behind the fake breakout and the breakdown trap. So the only question left is, knowing what you know now about market structure and manipulation, are you going to keep swimming blindly as a small fish, or will you wait for confirmation and swim safely alongside the sharks? Thanks so much for joining me on this explainer. Stay disciplined out there, and seriously, never trade a blind breakout again.